So now let's head to our next session, which is by Mr. Karan Beer. Mr. Karan Beer is an ex-venture capitalist and is currently heading the startup relations for Let's Venture, India's leading private market investment platform. In his current profile, Karan Beer overlooks deal origination, investment analysis, and relations with venture capital funds. Personally, his key areas of focus are D2C brands, Industry 4.0, clean energy, retail and marketing technology, robotics, drone and defense technology. Previously, Mr. Karanbir headed the partnerships at Windrose Capital, an early stage venture capital fund. His key areas of accountabilities were deal origination, driving co investments with other VC funds, family offices, angel investors. He also overlooked the portfolio life cycle investments and exits. So we welcome you, sir. Over to you.
Thank you very much, Soumya. I hope you guys can hear me well. And
Yes.
thank you very much for the kind introduction. It's quite an honor to be here joining you all. It's special to me on a personal front as well. I was born in Chandigarh, so the city is close to my heart as well. So thank you once again. I hope through the medium of this, 1 hour session, I can add value to the aspiring entrepreneurs here. I've been informed that most of the audience members are first-time entrepreneurs, will be raising perhaps for the very first time, very early in their journey. So I've also tried to tailor the entire session, the presentation accordingly. Towards the end, I'll also like to make it a little interactive and take a few questions if that's okay with the organizers. So thanks again. Let's dive into the masterclass, as you call it. So what I've tried to do, and this is something I speak of during my one-to-one sessions with entrepreneurs whom we are helping raise funds, and we do so every day. That's what Let's Venture as an organization does. That's what I've always wanted to do since a very long time. I've been doing it. I've raised through venture capital funds, strategic investors, which are industrialists, through financial institutions, your typical legacy financial institutions like banks. So various kinds of capital that I've raised for different kinds of entrepreneurs at different stages of their life cycle as well. Right. The common denominator in all of these journeys, I would say, has been the story that the entrepreneurs bring, right? And it's, I think, largely misunderstood. When you talk to an entrepreneur who's raising funds, you talk as an investor, and I've been on the buy side for some time. Uh, People are very close to what they're building, to the product, to the company, right? They lose track of the larger vision, the larger scheme of things, and what really matters to the other party as well. So through this session, I'll try to bring the focus back to the very basics. Not only that you're raising, but and how you're raising, but why are you raising at the first place, and whom are you raising from? Because we need to keep that in focus. And hence, I've titled this as communicating vision and value, because if we can do that, the fundraising journey becomes fairly easy. That's an important thing to know. Another important thing to note is that I've tried to limit the fundraising discussion today to the Series B, Series A and Series B level, starting from the very early stage of angel stage, because most of the audience members are early stage entrepreneurs. So I've tried to do that. Right, guys. So before you start to learn about the fundraising art, it's very important to also learn whether raising funds from angel investors and VCs is the right way to go for you or not. The only thing which tells you whether it's right or wrong at the very beginning is what sort of a business are you, and how do you define the success of your business and individual success as well. It has to be very aligned with your entire life cycle and roadmap. So for an example, a 50 crore revenue business is a good one, right? A traditional business, I mean, something like a manufacturing unit. You will be successfully running it, you'll be happily running it. So as an entrepreneur, you're successful. But is a manufacturing business the right business to get a VC investment? No, it's not. So it's very important to know what are the right types of businesses that are fundable or investable by VCs and angel investors. So if you're approaching angel investors as your first stage, the intent is that you will raise through VCs later on. So you have to keep that in focus. You have to identify whether what you're building is a investable business or not, first and foremost. So how do you go on identifying that? So let's talk about what are the key things that sort of define to a large extent whether a business is VC fundable or not, right? You would have heard this from a lot of people, mentors, advisors, investors, if you have them already, fellow entrepreneurs whom you might have reached out to, that scale is very important. But what is scale? I mean, you look at large manufacturing units, again, traditionally, they operate at scale, right? There are thousands and thousands of crores. So they are operating at scale. But is it the same scale we are talking about? No. So when a VC says scale, does your business have inherent scale into it? What that means is whether your business has the potential to replicate the solution that you're offering to your clients to a very large market in a very short period of time. That is what the definition of scale coming from a venture capitalist is. That's important to note. So manufacturing unit would not fit this definition, right? That's the difference. A software business, a SaaS business would, because you can quickly replicate that. You pump in money into marketing and sales, and you can replicate that. Your operations will scale very, very exponentially along with the sales. That happens, right? The second point to note is what do VCs actually invest in? Very critical to know. I've tried to summarize this. They try to fund the plans of accelerated sales of applications of value innovation. Okay, let me break this down for you guys. You're building a solution which needs to innovate value. What I mean is it needs to eliminate value cost trade-offs. So it doesn't mean that you lower the price and you eliminate some features from an existing product that's out there in the market and you say I've become competitive because the price is lower. It also does not mean that you add more features to an existing product which is being sold by another company and then say that I have a better solution because it has more features. But then the price is also higher, right? And it's only an addition of features. It's incremental value. That's not what value innovation is. Value innovation is when you can give more value to your customer at a specific price point, right? Catering to a need or a demand. And this has to be a burning need and demand in most cases. In most cases, that is what it is, right? And VCs will try to give you money, okay, invest in you so that you can accelerate the sales process of the application of this particular solution. That's what VCs are funding. Now, when they fund this, you will see, and we all very commonly make jokes about how the likes of a cred are not profitable businesses. They burn so much money, they make so many losses. That's not the point. And we'll come to that. So do not look into the balance sheet and judge whether the business is good or not. Okay. Third point, VCs will always look at competition because they want to invest in companies that are going to be market leaders. So if you are not going for the top three positions in the industry that you are going to play in, the vertical you are going to play in doesn't make much sense for VCs. Not many VCs will actually invest in you. Yes, initial rounds of funding might happen because that level of data, all companies in that sector are new. But if you look at Series A, competition really matters. So you have to always align yourself for market leadership, and you always have to think that there is competition. How do I beat it, right? And when talking about competition, you all then automatically have to talk about differentiation. That very, very important. So how do you bring in that differentiation, right? Pricing is just one thing. That's not really innovation, right? This has to be solution differentiation, and this has to be transformational in most cases. Incremental differentiation typically does not get well funded, especially at the mature stages. So this has to be core differentiation either in the solution you are bringing, right? It should add a lot of value, new value to your clients, okay, which have been underserved right now, or not served at all, or this has to be a business model differentiation. So example of business model differentiation or innovation would be an Uber, right? Taxi services were already there, but Uber innovated that model completely, right? The fourth point, and this is again a very common question, a lot of Indian VCs will ask you from the angel or the seed round, which is, do you have a moat in place? Well, honestly, I disagree with this question when VCs ask it at a very early stage, because moats do not get built early on. You can't, and there's no company in the world that has built a moat early on, not in my knowledge at least. But what you need to actually figure out in terms of strategy is that when I am about $100 million business, does does a defensibility start to build in to my business and industry by virtue of my model itself or not, right? And what that means is, now that if I'm operating at scale, can other companies easily come and take away my clients? If the answer is yes, right, then you're probably not building a good defensible business. Okay, you don't have an approach to building those modes. So you should have that thought, and you should always try to do that. Right, early on, do not. I mean, you should have that thought, but you can't build in the mode. So don't waste too much time there, but have that thought. Next point would be relating to what I had mentioned earlier, that P&L losses in the present day do not imply bad economics, not at all. Cred has a lot of burn, a lot of losses on the P&L level, on the balance sheet level, does not mean it's a bad business, does not mean it has bad economics. The game plan is very different. Okay. Similarly, when you are building your business, when you are designing your corporate finance strategy, you will realize that if I have to go capture a lot of market early on, I have to do it at at a speed which is relatively unknown to the other competitors, right? Because it has to be very fast. You completely capture the market, right? And then start to monetize. A lot of businesses, especially consumer tech businesses or product led growth businesses, do this, right? What that means in the early few months and years, you will not have profitability on a P&L level. On a unit economics level, yes, but not on a P&L level, right? And that is what the VCs are there to fund. So do not ever think that you are building this business that from day one I'm not profitable. It's okay. VCs will fund that if you are a good business, right? But unit economic level, you have to be positive. So you need to know the difference there, right? So study these basics, consult a strategic CFO. I mean, if you want to scale, you will have to bring a strategic CFO in house as well. But have these basics very, very, very clear early on. So this is a very, very foundational view into a typical business that is fundable. If you are a business like this, would you raise an investment? For sure, no. But if you are not one of you're not one of such a business, you are definitely not going to raise from a VC. So that's what this slide is for, to see whether you are on the right track or not, right? Moving on, going to the topic, the vision and the value, right? Extremely important. I believe this is the extremely, it's paramount. If you cannot really see yourself going after a vision and creating value, I don't think you get funded. Maybe you raise one round of funding, but when professional investors, institutional investors come in, you really, really fall behind, right? So what are we talking about when we say vision and value, right? There has to be a larger scheme of things, but it has to be realistic, has to be practical, both things at the same time, right? And it has to bring in value to all stakeholders, beginning with, of course, your clients who pay for your services, right? Let me take up the first point. The eventual goal is to change the status quo and set a new norm. So all successful, very large funded businesses these days, name a few, right? Uber, Zomato, they have changed the status quo. How were you taking a taxi early on? You were going to a stand, walking in the heat, perhaps waiting, negotiating, haggling. The driver said, no, I won't go. Then you waited and saw if there was a line of auto rickshaws in place. Perhaps went to that and said, Bhaiya chalo. And he said, okay, I'll go, I'll charge you 300 rupees. He said, no, 200. Why don't you go and use the meter and blah, blah, blah. Then Uber came and said, to its investors, I'm going to change the way people are going to travel intra-city, right? I'm not going to let them go walk in the heat and negotiate with taxi drivers. And so it moved the balance of power into the client's hands, right? It gave them supply, right? It changed the status quo, changed how people behaved. And this is applicable to enterprise businesses as well. Now, enterprise businesses or startups building tech, did they change how enterprises actually function? They make it far more efficient. And with time, what happens is things normalize. And I'm going to, borrow this very cliched line these days, that it's the new normal. That's what they're trying to create. Uber is now the new normal. You don't go and negotiate with taxi drivers anymore, right? It is the new normal. That's what the grand vision of these very lovely startups is. It can't be realized on day one, not after an year, 2 years, but it eventually does. And you need to project this vision while you are fundraising. You have to do this very confidently, right? And you have to seem like the team who can pull it off. Okay, that is point number one. You can't say that I'm raising this round because after this round I'm going to do this. That is tactical, right? Founders become very tactical while fundraising, while even operating. So you need to take a step back, take a 10,000 feet view, and look at the broader scheme of things, build a strategy for it, and also communicate that. That's the first point. Second, very important, as a startup, you need to aim for market leadership. Okay. You can't be saying that I will become a company who will have 5% market share. No. If your solution or your type of solution is being used by a million customers, you need to say to the VC, and you need to plan, you need to strategize for at least 70-80% of that market. You need to say that tomorrow Uber is going to be the only one, right? Or it's at least going to be in the top three. But personally, you should be going for the top position there. You have to aim for market leadership. Otherwise, you're better doing something else. Trust me. It doesn't make sense for a VC to invest in a business that's going to be one of 30. Doesn't make sense. And at Series A, you will see you get dropped off. You don't raise an investment. That's what happens, right? So aim for that, strategize for that, plan for that, build your steps accordingly. And you need to communicate this very confidently again. Third point, explain how your customers benefit. Very important, very important. And this has to be a monetary benefit. Okay, one is conceptual benefit. Mostly what happens is in enterprise businesses, especially, this is more pronounced. I'll use that as an example. You go and say that I'm giving the solution to large enterprises, Fortune 2000 companies, and I will help them reduce their cost. Okay, by making their let's say operations more efficient, so I'll reduce their cost. I as an investor would ask you, okay, you are doing this, and yes, your solution, your tech looks like something that can reduce cost for sure, and you are charging them this amount. But how much is that cost reduction on a P&L level? Most entrepreneurs don't have a thought on those lines. So you need to say that, okay, if an organization deploys my solution in 2 years, there will be about a 1.5% improvement in the bottom line of the company. Okay, which is huge, by the way, for a Fortune 2000 company. Or you should say that because I am improving the marketing function, I will help them increase revenues by 7%. Again, for a Fortune 5000 company, 7% increase in top line is good, right? And then you say, I am only charging a 2% of what I'm saving for them, or a 3% of what I am actually additionally making for them, right? That's when the VCs realize, okay, this is a very large game. And all of this, right? I'll connect it to the fourth point. When you say all of this, and you take them through a bottom-up analysis of the total market that you're going to capture, that if one enterprise I can do this much, right, then for 2000 enterprises I can do this much, and I'm going to charge 2% of it. That means annually I'm going to have $150 million ARR. This is a very large dollar value, and this is what you need to project. Now, no investor VC would ever expect you to do that in year one. Nobody does that. And you yourself will not be doing that, right? So you need to tell them, I'm going to capture this market slowly, but I have to start somewhere, and this is where I'm starting. That's how you will have to project the vision and the value. These are four very basic things. Okay, and everything falls under these categories. This is what eventually it actually boils down into. So I started with this. So please keep all of these points in mind while going through the rest of the session. Just a moment. So coming on to the next point, and I cannot really highlight the importance of this particular slide more. And it's unfortunate that most founders miss out on this. They think about fundraising as an activity outside of their startup, as something which is done in isolation. Okay, it's not the case. Uh, if you're a finance professional, you will realize that investment is a core activity, core business activity, right? It really is. You have to look at corporate finance, strategic corporate finance, as a very important division in your startup from very early days. You might choose to work with a banker, right? Good, but you have to integrate this with the larger scheme of things and the corporate strategy. Extremely important. From day one, you need to think on those lines, right? Otherwise, you'll always be falling behind. You'll always be taking a very tactical route to fundraising, which does not work well for most companies, right? I think when you do a tactical approach to it, it's mostly luck that plays, or it's mostly investors who are, I think, kind enough to strategize and brainstorm with you to lay out the entire scheme and then invest in you. Otherwise, it doesn't work out. So let me cover this point by point. Okay. First of all, fundraising is not an isolated single event. It's not. It's always going to be a series of events. It's going to be a chain, sequentially done, right? Periodically done. Periods of time will differ and will be based on milestones, which are, let's say, corporate life cycle milestones, not yearly milestones per se, right? But it is not an isolated event. It's not a single event. So my advice is, when you're raising a first round, tell them that I'll need to raise 6 7 rounds. This is the first one, a small check, because with the first round I will achieve this milestone. That's how you should be pitching. Not that I'm raising the angel round and 12 months later I'll raise the seed round, which will be 3 times or 4 times my angel round. What is the rationale behind that? Even you are not aware. When you take that approach, when you're tactical, even you're not aware, right? Shows the lack of depth as a company builder. So don't take that approach, right? The second point, and all of these points are related, by the way. An investment in the company has to be an integral function of a strategic corporate finance. Well, let me explain you why I say so. Your larger scheme of things, the larger vision, the larger value you want to create, which is $150 million ARR, right? By saving about $1.5 billion for your enterprise customers over a period of 5 years, a very long term play. You will achieve this by developing first an enterprise, various products within that enterprise, right? By developing different marketing strategies, by hiring talent, by having and scaling operations, by having some infra. And then there will be cash flows you'll have to deal with, right? All of this is core to your work, right? And to fund this, you need VC money. Okay. So the raising of capital has to be an integral function of this entire corporate finance division. You have to accept that, and you have to work in a very focused manner on that from day one. Good founders do that. Good bankers help you do that as well. And good seed funds and angel funds also help you do that. And because it's going to be an integral process, everyone in the top leadership needs to work together in this. Okay, you can't really say that my CFO is going to handle this activity. Well, eventually he can be the person, or she can be the person who goes and communicates to VCs and investors. That's okay. But while you're building the strategy, even if you have hired bankers, the CEO has to be there, the CMO has to be there as well. Right? Initially, it's the CMO, CEO. The accountabilities are sort of blended in a way. But the leadership has to come together and see what this plan really looks like, so that everybody is walking the same path, right? Divided into goals, of course. So everyone has to do that, and you have to cover the major corporate and product lifecycle design into this particular fundraising strategy while you are developing it. Right, the leadership has to be on the same page here. Fourth point, you need to cover the product roadmap, as I discussed above. You need to cover the marketing roadmap, and this is going to be stage-wise, which we'll come to later. What I mean stage-wise. Talent roadmap extremely important because it's not always going to be 2 or 4 founders who started out. You're going to need professionals, going to be expensive professionals. You'll have to build up ESOP policies. You'll have to build up or have a thought to build up operations, infra, right? A lot of those things, and you'll have to see if my sales is actually scaling up right after funding, and then it's going to grow 5 times within 3 months. My existing operations, my existing infra does not support it, right? In that case, you also need to scale your infra as well, your operations as well. So you need to focus there as well. So what is the money that is required there as well, right? Need to get that into perspective. And most importantly, this is where a lot of startups go wrong. They look at a P&L figure, okay? They don't look at cash flows. Your cash flows are extremely important, very, very, very important. Many startups can be P&L positive, but might mostly are not cash flow positive, right? That means you will see that, okay, on paper you are going to be profitable, but actually there's no money in the bank for next month. So you have to incorporate this into your fundraising plan and tell that to the VC. Okay, this is extremely important as well. And I'll tell you a difference. Let's take the example of an enterprise SaaS company, and if you're charging a monthly subscription to your clients, right, you will have, and let's say your ARR is now good, right, and your MRR right now is about let's say $300,000. Okay, so every month, because it's a subscription model, you will have 300K, right? Let's say you're doing this at break even. There's no profitability right now built into it because at a P&L level, not unit economic level. So you have 300K start of every month. Whereas if you're charging an annual subscription, you have 300 into 12. That is $3.6 million upfront with you, right? That's how cash flows matter. You need to incorporate all of that into your planning while raising funds. And hence, it's important that your marketing function also pitches in while you're developing the strategy. The fifth one is the need to incorporate the competitive landscape into the fundraising strategy. Very important. See, building companies, running companies is a sport. Okay, it's a competition. There are only going to be top 3 players, right? You take any sports, you take the Olympics, top three players, top 3 teams are crowned, right? And that's what market leadership will boil down to. So that means you also need to keep an eye out. How is my competition building up their company? What sort of plans do they have for fundraising? What have they already raised? Who are their investors, right? And you need to tailor your plans accordingly as well, right? Otherwise, your plans can actually go for a toss. You'll never become competitive. So if they are raising top dollar, you need to do that as well. So very important for you to incorporate that. Next point. Yeah. Okay. So now making things and getting things into perspective for you guys. I used to have this old view, and this old view was shared by a lot of VCs and investors who used to work about a couple of years back or so, even a year back as well, which is like, if you look at your life cycle, startup life cycle, you start at zero where you have a concept, right? A very basic idea, you have a business model. Then you go out, you raise angel capital, you build that MVP. Then after you build that MVP, you raise a seed round and maybe an institutional investor comes in, right? Or maybe an angel platform like Let's Venture helps you. Then you take some bit of time to build the PMF, right? Took about 18 months or so. After you build the PMF, you raise a Series A typically, and in between you could do a pre-Series A or sorts, right? And then you went on a high growth trajectory. Typically, that's the model. It has changed now. Things have shortened. Your time to market has actually reduced. More money is flowing in, so things have changed, and this is what's happening now. Okay, you start here at one. Of course, this journey remains the stage, the angel to the seed stage, which is the discovery of the PMF or the building of the MVP. Sorry, stays very much the same. But this time to market, right, for your PMF has reduced drastically, and a lot of money is going in at the seed stage. So typically, A seed check which was about $200 to $300,000 earlier is now even $1 million now, which is very, very good for entrepreneurs. It's a blessing, but that also means you need to hire more talent, good talent, work fast, and launch a great product, and find that PMF very, very soon in your life cycle, right? Reduce that timeline. And that's where you do a massive Series A to go very fast. And then the Series B comes in. And of course, from this point 5 in your life cycle, you will be on a relatively high growth trajectory. And next slide onward, we'll dive deep into each section of it. So let me take that out. But very important for you to keep this entire chain in perspective. Yeah. So what is the first stage? The 0 to 1 journey, right? Which is at 0 is typically where you either have an MVP, okay, you're just talking to a few clients, have a few POCs. Maybe if you're in consumer app, you're just really given the app out for downloads, basic traction, right? May not be monetizable traction, but you do see some customers coming on, leaving the application, giving poor feedback, but you build something, right? That's what an MVP is. Or for some founders, right, who are serial founders, they also raise on a business plan level and say, I'm going to build this, I need money to build this. They're able to raise that money, right? That's the angel stage, right? So characteristics, I'll only a lot of characteristics, but majorly you will have very few customers here, and then you will have a product which is usable. It's not a product that adds a lot of value. It's usable. It's an introduction to what you're actually building, so your customer gets some view. Okay, this is what this is going to look like, right? That's what the MVP stage is. MVP to the 0 to 1 journey typically should be around 12 months or so. All right, we see 9 to 15 months. Ideally, it should be 9 to 12 months, not longer, because the space is becoming very competitive, right? Angel rounds are typically anywhere from and actually 50K to 200K or sorts, right? That's what it is. These days, a lot of angel investors are present. They're happy to write these checks, take that risk capital, right? They do that. That's what it is. Once you have that MVP in place and now you're deploying that, right, and you go back and you show some degree of traction, some enterprise clients if you are a B2B tech company, or you show some good downloads, right, you show some good feedback as well, and there are repeat customers, you're able to charge them on a subscription, you're still improving the product, by the way, okay. That final product isn't in place, we're still doing that. That's where you raise a seed, because then the priority really is that you improve this product, you build depth into the product or the solution, okay, and for which you will need money, of course, so you raise slightly larger amounts. With this money, you also, what you ensure by building depth into the product, a key component in your strategy should also be to increase the switching cost for your client, so that because you've spent a lot of time and effort on getting that customer, you ensure that if another competitor of mine comes in tomorrow, he or she should not replace me with this client. So when you build depth, you actually create a level of defensibility, right? That should be the aim from your journey between the 1 to 5 points here, life cycle points here. The third one, during this journey, what you have to do is to keep speaking to new customers, but don't go for high growth here, right? Why? Because your final usable product that can actually scale very fast is not ready. Your operations are also not ready. Your infra is also not ready. So keep talking to new customers a little passively, keep them warm, try experimenting with your existing line of solutions with them, but don't spend a lot of dollars into capturing new market. Okay, that's what you do while discovering the PMF. Now, a lot of people ask, what is PMF? I mean, the definition is product market fit, right? How do you realize if it's PMF? No one right answer, but what a lot of founders suggest is there is a point where the enterprise says that this is a product I really like, let's deploy it as soon as possible. And then you will see incoming demand for that product as well, or that solution as well, right? And a lot of customers will start trickling in, and your sales team will start to complain that operations is not able to manage the load that I'm bringing in. That's a, that's a point where you realize, okay, I have something going well for me. That's typically PMF. Now there's another important thing to note which a lot of startups miss, that PMF has now, not now, it always has been a dynamic concept, because what happens is the requirements and needs of a customers change with time, right? And they're changing with time more and more aggressively now. Okay, so that means 24 months later, there is going to be another startup trying to displace you with a better solution. So you have to keep an eye out, and they are going to tell your customer that this is a need which your current solution provider, which is you, is not really catering to well. So why don't you try my solution? And that new startup will start to displace you. So that might actually mean you are losing PMF. So you might also have to iterate this product, right? Which for you is going to be a relatively easy process, because it at times is more of an incremental feature set that you need to introduce. So, but do keep an eye out there. Now, once you hit this inflection point of finding a PMF, this is where you raise your Series A, right? And in between, by the way, in India, between the seed to Series A, there's a lot of pre-Series A and bridge round financing that happens, because, well, you need more capital to develop a product. You feel that I want more traction and I will do a much larger Series A. That also happens. But typically it's seed and then Series A. Those from a milestone perspective, from a life cycle, from a corporate life cycle, those are the two major fundraising rounds. Now, Series a whole different animal. Okay, it you cannot only talk about vision. This is where the importance of that value, that monetizable value, really comes in, right? And your game plan also has to change in terms of the focus area. Now you have a product that can sell very well. So what good founders do is that they now aim for market leadership. This is the product you have found, which we call the hero product. And with this product, you go for market penetration and market capture. You say there are 2,000 companies that I can address. And within the next 24 months, I'm going to capture at least 50% of them. That's the goal. Okay, that is the goal you're going for. So first 12 months, let's say first 12 months you go for about 20%, and then another 30% in the next 12 months, right? That's where you really take this product, pay a lot of good salespeople to take a product, sell to these companies, conquer the market. That's the focus. So hero product, right? High focus on sales. Parallelly, you expand your operations and infra, because you need to support your sales team, because your customers are coming in, and your human resource will also expand. So all of this you are doing after raising this round, right? But you have to keep in mind that the money has to come in earlier, right? So you plan what is the finance needed, and typically this is a multi-million-dollar round that you will have to plan for. Another important thing that Indian founders don't do well is that they shy away from asking for millions and millions of dollars. They believe that I am a small company. I started raising 100K round. I should only raise maybe 500K, $1 million, $1.5 million at the Series A level. Why? You were pre-PMF. You did not have a product. Your focus was something different. Your goal was something different. That's why you raised a smaller amount. Now you are going for market capture. You need much more money. Otherwise, you can tell this VC that if you want me to be 10th in the game, I can take small money, but that does not work well for me. I want somebody who can give me more money so that I can be number one. That's the key at Series A, and that's what you should be going for. The next step, once you are, and hopefully things go well, things get real after the Series A, because VCs and investors and you yourself should think about the P&L as well, right? You have to think about not only unit economics, but improving cash flows, a thought on profitability. I'm not saying focus only on profitability. No, product-led growth would also mean that you're still not profitable on a P&L level. It's okay. That is still okay. But have that focus, because these rounds, Series B onwards, are going to focus on your on your plans to that profitability. So you need to have that thought and conviction that, when I actually start to monetize them in a way which makes me profitable because I've conquered the market now, I'm going to do that with very high gross margins, about 70-80%, which a lot of enterprise SaaS companies do, right? That's the goal. And Series B, what have you achieved? You've achieved that 50% of the market is yours with one single product. They have started to pay you, right? Now what you need to do is build, and in parallel you will building that product suite, right? More products that you can sell to the same customers. Now at Series B, you start to launch these new products. So your expansion revenues grow as well. Same client, but more revenues. Your CAC is already done, right? You already conquered that market, right? That's where profitability starts to click in. And you also start keep on conquering new markets. That is what market leadership looks like. So at Series B, this is going to be a much larger round. Expanding product suite has to be a focus. Penetration in client organizations to increase the revenue. I missed that word, sorry. uh, Penetration in client organization, what I mean is go from division to division and start selling, right? Within that organization, sell more solutions, conquer the exact same client you already have a foot in the door, right? That's the focus. High growth and new customers as well. You have the money, high talent, go after that, right? Appoint senior people there, manage verticals. That's what you have to do. And that's how your net ARR is really going to grow with that. That's the focus of Series B. And I'm going to limit our discussion today to Series B because beyond that, it's a different animal, different ball game. Not the right place to discuss. Now that you are aware on, what is to be done, how the trajectories look like, and how they are aligned with the larger scheme of things, you have to tell the story. That's where we started, right? That's the topic of the masterclass as well. Fundraising, communicating vision and value. So we started with the vision, a big theory, right? A big vision, changing the status quo, establishing a new normal, and you are the guys to do that. Great dollar value to clients and hence to yourself. Now this is the story you need to tell. You already have broken down, you have seen what that journey looks like. Take a backward approach. You have seen the vision, break it down into strategy, then goals have to be linked to actionable items. This is where dollar marks are going to come in, and then break it down to funding rounds which help you achieve these goals. This is the way to go. This is the storytelling. Okay. And remember, this is a tip I always give to all founders, and all good founders who actually pitch to us, right? And there are many investors at today's events as well. They will tell you that good founders are very good at telling the story and creating an emotional appeal. You will not even realize, but you are emotionally aligned with their vision, right? It's not the logical part of the brain that they appeal to upfront, because it takes time to click with the logical part of the brain, right? It is easier to click with the emotional part. That's what you need to focus on. Humans will always make emotional decisions. 50% of your job is done very early on in your pitch, right? That's what you have to do. So capture attention. This is a 1 minute game. You need to learn to summarize the entire game plan, the vision, the goals, the dollar value, what you're doing, problem set, client, everything you need to summarize within 30 seconds to 1 minute maximum, right? Higher focus on emotion. Focus on emotion, capturing the emotion of the investor. Put yourself in his or her shoes. Think, if you were pitching, what would attract me the most, right? That's what you need to do. And this could be different for different people. Could be that you are a splendid group of people, IIT, IIM, Harvard, etc., etc. Could be that you already have millions of dollars flowing in from customers. It could be anything at all, right? Develop interest, and you need to tailor this pitch to your capabilities. Develop interest after you've captured their attention. You need to paint a big picture, right? That was always the point. Focus on commercial value and tangible impact, because this is a more detailed discussion you are going to have with the investor. So you need to focus on that commercial value you bring to your clients and hence to your company. And if you're growing your company, investors will grow with you, right? Do some math to tell them that this is how you can return value. Don't put a number to it, but tell them that easily 100x is visible for me. Like if you can capture about 20% of the market while you're going for 50%, right? So, but be confident, have that conviction. And then finally build that desire. Okay. This is what the dollar value for an investor is. That's what desire for an investor is, right? Uh, Include that emotional value, but paint a picture without saying it that you are going to be a company who's going to be a unicorn. You're going to a very popular brand. If any enterprise uses a solution in your space, it's going to be you. Paint that picture in their brains. And that's how you raise capital. It's simple, right? This is the story. Broader picture in focus, break it down backward. Don't be tactical, be strategic, know what you need to do, use fundraising as a tool. Fundraising is not success. Fundraising is only a tool to actually capture what you have really set yourself for. And that's what I'll conclude with. Thank you, guys. I'll take questions if Soumya, you would allow. Soumya, can you hear me? Hi, Soumya. Are you able to hear me?
Yes, sir. I'm right here.
Thanks, Soumya. Can we take a few questions if that's possible? Would love to.
Sure. Sir, I have written a few questions in the chat, if you can see. There are.
Just a moment.
Yes.
Chat. Okay. Questions by Pulkit. What challenges competitor companies face in acquiring the funding for the same kind of startup? Well, I think the answer lies in the question, right? If you are a competitor company, you first need to see how big is the market, right? If this is a huge TAM market, the total addressable market is very, very large, right? And you are only the second player, less friction. In fact, you can use one of your competitors as an example. You can say to your investors that this company has already raised this funding while the market is so big. 5 years from now, the max it's going to have 20%. I can also have 20, right? Perhaps I can overtake them because I have a better strategy. I have better people to deploy that, right? But if this is a landscape which is, let's say, small TAM, and you are the third company, very hard to actually raise capital there. So you should not be doing that. It's not a VC business. That's the first point, right? First to second slide. Another scenario is large market, but there are 10 players already, correct? No point. No point doing that. I'll take the example of the food delivery segment. Can you today? Can you compete with the Zomato and Swiggy? No, you can't. No point doing that, right? Unless you have a very disruptive model, and you believe Zomatos and Swiggies can acquire you, and if that is the plan, and you are a very strong team, very, very strong, because that storytelling is going to be one hell of a task, don't attempt to do that. That's the candid advice I'll give you. Got it. So I'm answering the question from Yashvir, which is regarding when should you raise capital, right? So during the pitch, one thing I focused on, fundraising is a tool. Money is a tool to raise, to actually achieve the goals. So when you need it is when you raise it. Your valuation today, I'll tell you, Yashvir, is also dictated by industry norms. It is not going to happen that you raise a seed round of 1 million, or let's say 100K, and an investor says you have nothing to show for, and that is why I'll take 50%. Nobody says that. I mean, if they say that, tell them no, this is not how the VC game is played any which ways, right? It is anyways between the 10 to 25% mark, depending upon the team, the stage, the traction you have, all of those, the market size you have, right? You raise when you need it. So if you have your own capital, if you can bootstrap, if you can raise friends and family rounds, right, or have arrangements or raise through grants and build that proof of concept, right, build that MVP by yourself, better. You can raise a much larger round in the next step. So that would be my advice. Question by Pankaj: how difficult is it to get a first round of funding for a budding startup? There's no correct answer here, Pankaj, because honestly, good founders, good business models, funding is very easy. In fact, investors fight to get an allocation. Bad startups, and when I say bad, I mean in startups that are not investable. Okay, not bad businesses. They can't raise funding at all. They can't raise through angels. Even if they raise through angels, they can't raise through VCs. So if you're good, there's no dearth of capital, not at the early stages. Okay, not at the early stages. And if you are actually building for the long term with the vision, you will get your Series A as well, right? Unfortunately, in India, there's a very high drop rate from the angel to the Series A rate. That's also partly due to the lack of density at the Series A fund level. But having said that, there's still a lot of capital that flows in, even at the Series A level. So if you're building for the long term, you have the right plans in place, there's no dearth of capital. So if you're building the right thing, no, it's not difficult. Knowing the right people is a challenge sometimes for first time founders. I accept that. For that, there are organizations like ours which work with you, help you make warm introductions, prepare you. There are investment bankers as well, and do some research. You can reach out, but be prepared and you'll be set to go if you're building something nice.
Am I audible, sir?
Yes, Soumya.
Okay, so we have many questions floating in, but we also have a parallel session going on. I would like to thank you so much for the wonderful session. It was a truly enriching experience for all of us, and especially for the budding young entrepreneurs. We hope to host you again and learn more from you. For now, we would like to bring this session to a close. Thank you once again, sir.
Thank you, Soumya, and thank you everyone for attending.
Thank you, sir.